Hey everybody, my name is Sam Wong, and we're here to talk about qualified small business stock and how you, as a founder and as an investor, can maximize the tax benefits that come from it. This class is basically focused on at the end, we'll talk about a self-attestation, which is going to be pretty key for delivering and taking advantage of this QSBS benefit. It's a very big deal. Okay. To provide a little bit of background, as mentioned earlier, Sam Wong, I've done 5 startups. The first two shut down, the last 3 did get acquired, and I also worked with 2 other startups that also got acquired. So I've been through the M&A process 7 times. I've lost count now, 7 times, I guess, with 6 consummated acquisitions, etc. Having gone through the startup space the startup thing so many times, I did write a book. It's a little bit of a cathartic exercise. The book is focused on startup execution. Okay, so I tend to do a lot of teaching and speaking. I am an investor with Band of Angels. I've spoken at TechCrunch Disrupt twice, Lean Startup Conference. I'm an advisor over at Berkeley Skydeck, and a bunch of other various startup events. I encourage people, if at all possible, stay to the end here because at the end we'll talk and give you some specific detail and some actionable information about how you can take advantage of qualified small business stock. And I've been mentioning it several times, but what exactly is it? What is QSBS? It is an opportunity for investors and founders to pay zero federal tax on gains of $15 million or more. Okay, and that's qualified small business stock. There's a lot of press, a lot of articles all over the internet that talk about this very, very good tax program. And maybe I can provide a little bit of background about why it exists and stuff. And as you probably know, we are all incentive driven. Okay, incentives drive behavior. Just look at the how much retail sales come up on Black Friday because there's some pretty sweet deals there. Well, in the tax environment, incentives also drive behavior, and people who've designed the tax laws understand that. If you look at tax policy, charitable contributions in the United States are deductible from your income. Okay, there's also Roth retirement plans. So the goal is to help people, workers in general, save for the future, and the Roth retirement plan allows you to put taxable money, post-tax money into a retirement plan, and all of the gains of the those funds have will come out tax-free. Huge benefit. It's key to why most people can retire comfortably. Okay. Then there's also FSA and HSA pre-tax medical funds that you can use pre-tax dollars to pay for medical expenses. And there's also this thing called QSBS, investments that you make, stock holdings that you have in small businesses can qualify for this very, very attractive incentive. And the reason it exists is that small businesses are America's economic backbone. We want to be able to support small business, and the U.S. government wants to do that as well. So the lawmakers put together this package where QSBS is an incentive for entrepreneurs to start a small business or for investors to invest in a small business. Therefore, building the backbone and providing the fuel for small businesses and startups. Want to make sure it's clear, QSBS is a tax shelter, okay? And specifically what it does is QSBS is a tax shelter. It's applicable to both founders and investors. Sorry about that. There was a distraction in the presentation. So you as a founder can take advantage of it, and investors can take advantage of it as well. Okay, so how does QSBS work? All right, so there are a number of parameters that just make up the program, and before July 4th of 2025, they had one set of parameters, and after July 4th, a different set of parameters applied. And what it is specifically is that there is an exclusion cap, meaning the gains that you have from holding stock in a small business, up to $10 million can be excluded from your taxable income. After July 4th, that number increased to $15 million. There's also a side note or 10x of your acquisition cost, but most people don't take advantage of that. It's usually the 10 or the 15 million. Okay. If you hold the stock at least 5 years, then 100% of that $10 million is excluded. After the July 4th, if you have the stock after July 4th, it's actually a graduated step up where 3, 4, or 5 years you get gradually more and more of the gain excluded from tax. It only applies if the company, when you received the stock, has assets of $50 million or less. If it was before July of 2025 and after July, that number went up to 75 million. So slightly larger companies can still be eligible for this QSBS exclusion. The stock before July had to be issued after September 27th of 2010 and July 4th. If it was issued after July 4th, then the higher, more favorable benefits apply on the right-hand column. Okay, so I do want to make sure that there's a lot of detail, and we do encourage people to consult qualified financial and legal experts on your specific situation to understand how this may apply to you. Okay, so these are the parameters of how the QSBS is made up. Well, what's the impact? How good of an incentive is it? Well, let's run through a specific scenario. Okay, so let's say you build a startup, or I, as an investor, invest in a startup, and it basically provides 25% more proceeds on a positive outcome. So if you build a startup and it has an acquisition, it gets acquired, okay? If you do not have QSBS, you get a certain dollar amount. And then if you do have QSBS, the tax profile differs. So let's assume that it was a nice exit and your gain on the stock is $15 million. That's the same whether you have QSBS or without QSBS. So there's no difference there. You make $15 million in both situations. If you don't have QSBS, you don't get to exclude any of the gain, zero. But with QSBS, you can exclude up to $15 million, assuming that this stock was acquired recently since July of 2025. That means your taxable gain without QSBS is the full 15 million, but your taxable gain with QSBS is zero. Capital gains tax rate right now is 20%, okay, and it applies whether you have QSBS or not. And for those of you tax savvy folks out there, you might say that the capital gains rate is 15%. Yes, it is until your income exceeds $600,050. So if you have a gain of this magnitude, you're going to be in the larger capital gains tax rate, which is 20%. So 20% on your $15 million gain without QSBS would be $3 million in taxes. With QSBS, you pay zero. So your proceeds after tax would be 12 million without QSBS and the full 15 million with, which is 25% more take-home pay. It's $3 million difference here. Okay. And there are actually advanced strategies for QSBS stacking where you can increase it above $3 million. I'm not going to get into that right now. If we have time, maybe we can talk about that later. So that 25% matters a lot. It materially impacts the return on investment, your internal rate of return. That's a big deal, all right? So for myself, I have made, as an angel, 9 separate investment checks in 18 months. I made sure that all 9 of those investments are eligible for QSBS because the 25% extra gain matters, okay? Well, every savvy investor who understands tax management, tax policy, tax planning, they're going to want to know, does your startup qualify for QSBS? Well, one thing to check on for a simple thing is only C corporations qualify for QSBS. If you're a startup and you're an LLC or an S corp, sorry, you don't qualify. You have to be a C corp. Now, if you are an LLC and you convert to a C corp upon the conversion date, then and your LLC ownership units convert into C corporation stock, then on the date that you convert, then you could be eligible. This is just one of many, many rules for QSBS. Okay, there's lots of detail here. In fact, you may hear QSBS referred to as Section 1202 tax benefit. That's referring to the section of the IRS tax code. This screenshot of those 12 individual pages of fine print, those are the rules to qualify for QSBS. It's pretty detailed. Okay, so investors, though, don't want to read the fine print and try to study whether you have made yourself ineligible by anything that you've done, etc. They don't want to do an audit. So, how are investors going to know whether you're eligible for QSBS? Well, it comes down to a QSBS attestation letter. Okay. An entire industry has grown up to provide these QSBS attestation letters where there's a specialty service provider. They will gather information from you about your startup and they will analyze the information that you provide in order to say yes or no whether or not you satisfy from their analysis whether you satisfy the QSBS requirements. Okay. This industry is fairly significant, but you will end up paying the service provider anywhere from $2,500 to as much as $25,000 if your situation is very complex. Okay. There are a couple of options here. The QSBS attestation on the upper left is from Carta. On the lower left, it's from a company called Aquesta. There's specialty tax providers like Baker Tax Law on the lower right. They'll do it as well if you have a very complex situation. So putting this session together, I focused on, this little thumbnail image, and I wanted to call your attention to the fact that there's that little stamp in the corner that says self-certification. Okay, and what that's referring to is I, as a startup advisor and fractional founder, I have put together a lot of tools to be able to help the startups that I work with to be tax efficient or to be financially efficient or to raise funds or to whatever. I have a whole library of tools. One of those tools is an informal QSBS self-attestation form. And what it does is that I've looked at the nasty 12 pages of fine print on the QSBS requirements. I've summarized it to 7 of the most common things that will come up. Okay. It is not necessarily thorough and authoritative. It's a simple summarized basis. So I've got these 7 different rules here that I've summarized and basically put together a form that you as a founder can initial and sign and provide to an investor saying, hey, this is my own self-attestation. I've looked at it. I've analyzed these 7 key criteria, and I believe that it is that we should qualify. It is not authoritative, but of course, neither is any of these attestation letters from a third-party service provider. They do not speak for the IRS. Okay, they are offering an opinion and an opinion only. Okay, so what you're paying for is their analysis to be able to give you that opinion. So here in the attestation form that we have as one of our tools, we have 2 different versions, one for before July of 2025 and a different version for after July 4th of 2025. Okay. So again, make sure that if you go down this path that you should contact and work with qualified financial and legal experts who know your specific situation. What I'm providing here is a simplistic tool if you want to just do a self-attestation and save yourself the $2,500 to $5,000, which is the average price that the service providers will charge. I also, in this form, provide additional links so that you can get additional information to understand and do your own analysis and get enough information so that when you say, I think I qualify for this, I'm pointing you as a founder to the exact reference of the Section 1202 tax code so that you can, if you really wanted to study the fine print, and look at that and make sure that you believe that you are providing as authoritative information as possible. Okay. So there's a couple of questions in the chat window. Um, the exclusion cap is per investment, okay, or per stakeholder, per stockholder. All right. So basically, it's not limited to the entire company. The $15 million does not get shared amongst all of the founders and all the employees and all of the investors. Actually, m most employees probably would not qualify for QSBS for fine print reasons. Okay. But let's see. It is on an individual investor basis. All right. And so if you have three different investors and they all get a $15 million gain, then all of them can enjoy up to the $15 million benefit. Okay. So there's another question. Does QSBS apply if I'm an US investor in a Canadian startup? And the answer is no. Okay. It has to be a US corporation. All right. Then there's another question. Is the date specified when the shareholder invested or the incorporation date? So this cutoff date, I assume they're referring to the July 4th, 2025. That date refers to when the stockholder acquired the stock. Okay. So not the incorporation date of the company. It's when the stockholder acquired the stock. All right. And is less than $75 million company value is at the time of stock sale? Effectively, yes. Okay. At the time that the stock was acquired, is the company worth less than $75 million? Okay. So I believe those are the questions I've come in so far. And just to provide a little bit more detail, this form is something that can save you from having to go to a third-party service provider. Okay. This is a DIY process where you don't have to go off to pay somebody $2,500 to $5,000. Okay. Well, how do you get the form? Okay. I have a startup excuse me, I have a startup due diligence class, best practices and tools. And as part of this class, I've got 22 different tools. If you've got to do a bunch of cleanup stuff or whatever else, I've got a bunch of tools to help you be able to do that. And it's not just cleanup; it's actually helping you build your startup and really go through the due diligence process faster at a lower cost with less hassle. So I myself have been through diligence. Oh my God, 25 plus times, either as an investor or as a founder. All right. And diligence is a pain in the backside. I hate it. Okay. But it's made easier when you have a good set of tools. Anybody here who owns a house, uh, hopefully you've got some handyman skills to save yourself from having to spend all sorts of money with expensive contractors. And when you're doing work on your house, your tools matter. So in this due diligence class, I've created a set of 22 different tools, which are included with the cost of the class. The class itself structures how to be able to do due diligence. It's not just about what, it's how to deliver and succeed with your diligence process. That diligence process, I organize it into 5 different categories of diligence content, and the list here shows 22 different tools. I'm going to highlight a couple of the tools for you. All right. The Diligence Response Manager is a tracking system. When you go through the diligence process, and let's say you're about to get an investment from a professional investor, that particular investor is going to give you a diligence checklist. Okay. Well, that diligence checklist might have 50 to 100 different items on it. What you're going to do is successfully, try to fulfill all the diligence requests, and you need a way to be able to track where you're at because it's not just, a 15-minute or a 5-minute question and answer. You're going to need to go through a lot of detail with that. Okay, so. This diligence response manager helps you to be able to track the status. I've used it over and over and over again. It's almost like running an agile scrum. I use this as a scrum master. I use this as a diligence master, if you will. Okay. Then I also have a cap table tool. All right. So it's got a lot of features that is not going to be on most cap table tools and outputs. I put this together to make it easy for myself as an investor to quickly track and analyze where the cap table is, who has what, how far people have vested their equity, what type of equity they have, what it's going to be on after the investment, the convertible instruments convert, etc., all those things. There's also a tool for a simple financial model that goes out 5 years from a bottoms-up perspective. It does multiple scenarios. There's a lot of low-level detail. I just use this tool to satisfy an investor's financial modeling request, and instead of spending probably a week on building out the financial model, I got the model done in about 5 to 6 hours. Okay, so saved me 30 plus hours in putting the model together for a startup, and that investor has committed to invest funds in the startup. Okay. Bottom line is time is money. Okay. There are hard costs you're going to spend with an attorney. If you don't prepare your diligence in advance, the amount of time that you spend with your attorney is going to go through the roof. I've had seen startups spend 150 to $200,000 in legal fees to close a priced round. One of the startups I worked with spent $221,000. They should spend somewhere closer to about 100,000 to close a priced round. So a lot of that extra cost was the diligence work. So that's why I put together this diligence toolkit. And that's not even counting the soft cost, which your own time, which is probably much more valuable. So if you look at this diligence class, it's really here to help companies and founders save time and money. Okay. So I've mentioned already the QSBS attestation form, which is what we've been talking about. Then I've just highlighted three of the other tools. So there's 22 tools total. We sell the class for $299. ROI on this can easily be 50x. Okay. I'm not trying to, retire off of this. I'm trying to build tools to help myself run these startups and also help myself run the startups effectively and help them raise funds. But then from an investor side, if I get the investment content in this format, it cuts my investment review time in half. Okay. So if you scan that QR code, that's where you can go to get yourself a copy, a license of the class. I will go ahead and copy into the chat window the uh, the detail about if you don't want to scan or if it's not working for you, you can just click the link there. Okay. Uh, there's a question here. Is there a coupon code? No, because I think 50x ROI is plenty. Okay. It's taken me probably about 150 to 200 hours to build this class. So it's it's a bargain. All right. Okay. All right, so Laura has another question. So this is a presentation. Let's go through Q&A right now. Laura has a question. I'm saying price round. What is needed for safes or convertible notes? Okay, I think the context of the question is what is the typical legal fee for a safe or a convertible note? Okay, for a safe, um, most of the time, small safes do not incur a lot of legal fees, sometimes zero. Okay. And I mean safes that are under 25K, 50K, or somewhere around there. Oftentimes, legal review is not done as long as the safe hasn't been modified. Okay. Now, many of the startup attorneys out there do modify the safe because there are some problems with the safe. In fact, we had a webinar, the last webinar that we had summarized some of the problems with the safe, which are significant. Okay. And we went into an alternative to the safe. In fact, we're going to have another one of those webinars with a different attorney and a different alternative coming up. This webinar is going to be in about 3 weeks' time. Okay. So it's already up on Eventbrite. Let me know if you don't have the link to be able to register for that. Okay. But safes typically do not have a lot of legal fees. We have seen safes go as high as, 10 and $20 million. In those cases, because the dollar amounts are high, they do get lawyers involved, and legal fees can be five to $10,000 to sign a safe of that size. Okay. If you're also talking about uh, uh, the detail on there's another aspect here. So I've only been talking about legal fees. There's the aspect of the diligence cost. Okay. I am known as a fairly careful investor. In fact, I, as part of Band of Angels, I've some of my co colleagues at the Band of Angels says, "Wow, I'm pretty diligent and pretty careful, more than most of the other angel investors out there." And the reason I do that is research has shown that the number one reason why angel investors lose the value of their investment is poor diligence. Okay, that something could have and should have been caught in the diligence process, but wasn't. And since I don't have unlimited funds when I invest, I try to be very careful. When you, as a founder, do a great job with your diligence, if you run into an investor who's more careful, then you're going to be more you're going to be more prepared for that, and you're more likely to be able to get clear diligence from that person. In fact, oftentimes other angels who are looking at investing in the companies I've already invested in, if I've invested with them before, they know how hard I work at that, and the amount of diligence that they do is much, much, much lighter. Okay. Okay, where can you find, there's a question, where can I find the agenda for the class? Okay, if you are looking for the more detail about the due diligence class, let me paste in a different chat here. Okay. Okay. So I just pasted in the chat. There's a link where you can get more details on the diligence class itself. The first link was where to purchase the class. The second link here is where to get information about the class. Okay. Okay. Let's see. I don't know if there are any other questions. Okay, there is another question here. Uh, is the valuation threshold, the 50 million or the $75 million, is that threshold the valuation of the company or the assets? And the answer is it's the assets of the company. Basically, it's the assets. If you look on the likely it will be the asset number on the balance sheet. And you'll probably want to talk with your financial advisor, or excuse me, your CPA to be able to understand in your specific situation. You may have a unique balance sheet, but that is one of the questions there. Okay. Let's see here. Can shares be gifted by the founder to family members to achieve additional QSBS exemptions? Okay. So that John's actually asking a question. Can you gift the shares to achieve additional QSBS exemptions? And the answer is yes. I mentioned earlier the possibility of doing QSBS stacking. Now, what you have to do here is be very, very diligent and careful how you do it. The common way to do it is to set up an irrevocable trust. Okay. When you set up an irrevocable trust, that trust is taxed separately from yourself. Okay. So if you're an investor or if you're a founder, you don't even have to be an investor. If you're a founder, and you believe that you want to set up this up to maybe your kids, all right? You've got two kids and you want to have them have this QSBS benefit. You can set up two irrevocable trusts, one for each kid, okay? Each one will get their own tax ID, and then you gift part of your founder shares, or as an investor, your investor shares into the irrevocable trust. Because each one of them has its own tax ID, each individual trust could be eligible for the full $15 million exclusion as well. Okay. So that's the concept of the QSBS stacking. All right. There are other advanced concepts as well as like QSBS rollover and things like that. If anybody wants to know. Now, feel free to ask about any of that detail. Okay. I think we got stuff. All right. Okay. I think that's the questions right now. I don't see any more. Um, would love to see everybody take advantage of this. Okay. We're finishing early then. All right. Uh, don't see any other questions. Let's go ahead and wrap up. Thank you. If this was helpful, please like this video and subscribe to our channel. You can also check out our other videos for more startup content.